Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Dana Lyons, fund manager based out of Chicago, as well as editor of the Lion Share Pro website, which I will link to below this interview. Dana, as we usually do, we'll get some of your updated calls, what your models are telling you for a few different sectors here. We'll start off with U.S. equity markets. This week, or at least the last couple trading days, a bit of weakness came into the markets, and today we're seeing a little bit of a rebound. Seems like anytime we see some weakness in the markets, we do hear from people saying, oh, bigger corrections coming. Look at the recent run that we've had. This is the start of maybe another bear market, maybe another more significant pullback. What are your thoughts? Do you think the recent weakness could be finally that larger term pullback that a lot of people are looking for?
Thanks, Corey. That's not what we're looking for at the moment. We've discussed many times over the years. We are not that optimistic on the longer term prospects for the U.S. equity market. We think there's going to be a major reckoning at some point, and maybe in the broader averages, maybe they did top out, at the end of 2021, early 2022. But at this point, I think that rally that started in October, that intermediate term rally, still has legs to it. As at least that's what our data, our models are suggest. The quality of that rally, especially in November, December, was good enough that it suggests that we're not done. It's now a one and done shot. And that reversal at the beginning of the year is probably not it for that rally. So I do think after this pullback, this pause consolidation, depends on what sector you're looking at to describe the nature of this kind of consolidation or pullback. But I do think once it's over, we do get another extension of that rally, and in a wide array of market sectors, as suggested by the quality and the participation that we saw in November, December. So we are looking for further extension, therefore, of that rally before the meat of the next bear market, or I should say, the next leg down of the bear market does take hold.
Well, Dana, last time we talked with you, you mentioned something I was surprised by, that some of the value sector ETFs were doing better than many people expected in light of small caps and tech and the growth sector doing so well. How would you contrast now the setup in, let's say, the tech and growth stocks versus the value stocks?
Well, it's interesting because, as I mentioned, there is a fairly wide swath of market segments that are well positioned, at least for another near to intermediate term rally. Longer term, that may not be the case, but at least an extension of that post October bounce that we saw. And obviously, on the one hand, you have the growth stocks. You got the tech segment, large cap tech, that has held up extremely well. It's actually sitting right at new all-time highs. That is positioned well. So that we do expect that to continue to lead the way on the one hand. On the other hand, you have a couple segments in the value space, specifically a couple tickers I'll give you, RFV and RZV, which represent mid-cap pure value and small-cap pure value areas of the market, which strip out really any semblance of any growth in those segments. And you might be surprised to find out that unlike kind of the broader small and mid cap indices, these have actually gone back to new highs. So I think so from that perspective, from a pure value standpoint, there are pockets that are not only set up in the near term for an extension of the rally, but those are areas that are not even close to as extended or frothy as some of the growthier segments, like the tech segments that have really run over the last year or decade. Even some of these value plays have more, perhaps longer term durable potential behind it. So from that perspective, we're playing kind of both sides of the spectrum. And while we're not proponents of diversification for the sake of diversification, when you have a wide area of market segments that are actually displaying relative strength, that's a good kind of a definition of diversification.
So, Dana, does anything individually stand out to you? It does seem like a lot of these markets, again, kind of trading within itself, but any sectors that really are just screaming higher or completely breaking down in your eyes?
Breaking down, no. Outside of, you've got some few international markets. China's, for one, has been certainly awful, but you have a handful of international markets that are continuing to move to new highs. Japan, we like a lot. India, we continue to like a lot. And then from a domestic perspective, you have, like I mentioned, a good, kind of fairly wide array of areas that are working right now, from tech, like I mentioned, some of the industrial space, some of those value plays that I mentioned, and then some more specific areas. Aerospace and defense continues to move to new highs. Something like insurance continues to move to new highs. So unlike maybe that rally that we saw into July of this past year, that was extremely narrow, you've got, like I mentioned, you've got a fairly wide assortment of areas that represent opportunities right now, which I know is on the one hand a good place to be, in that you have, a number of different targets to throw the darts at, and in addition to that, it represents kind of a better foundation beneath the rally, beneath the market right now, that should at least give more fodder again to the notion that there should be extension of this rally before the next collapse occurs, because you usually don't have a collapse coming from conditions that are, that include more of a broad array, a broad participation of constructive sectors like we're seeing right now. So another area another factor that keeps me fairly optimistic that at least we're going to see an extension, or an attempt at extension of that intermediate term rally before the next shoe drops, for sure.
Well, Dana, let's shift over to the commodity sector. As you know, a lot of our audience is invested in resource stocks and commodities themselves. Let's start off with the big boy gold, and gold stocks. It's had a pretty good run at the end of last year, a very muted to lower move the beginning of this year. What's your outlook on gold? And then conversely, how do the gold stocks fit into the picture?
Sure. Really, nothing has changed that much. As you know, gold, we're very optimistic about. I think from a long-term perspective, it's set up extremely well. We had that rally to the COVID top, and it pretty much gone sideways for the last 4 years, and avoided really losing any of those gains outside of, some ups and downs, some consolidation, and kind of working off some of that froth that was built up. So now I think there's plenty of fuel, there's plenty of ammo for not only a breakout, but more of a sustainable breakout when we do break out, because it's not as, like I mentioned, conditions aren't as frothy as they were certainly 4 years ago. So you could see a run to substantial new highs if we do get that breakout. Now, on the flip side, obviously the gold miners and the equities within the space are not as constructive right now. They've pretty much been very uninspired for the last several years. With that being said, we do have smaller positions in the silver and gold mining stocks, just from an ETF perspective, because if we do get that breakout win in gold, that should lift up, obviously, the mining space, and it could happen in a hurry. So that's why we're holding a smaller position there, even though the charts aren't, like I mentioned, that inspiring right now in the short term.
Dana, looking at the GDX chart, the last 2 days were higher volume, and there are some, I guess you can argue, gaps in the chart due to some of those bigger drops. What do you view a chart like that, where it was trying to hold a recent higher low, it broke down out of there, but again, there are some gaps in the charts and there were some high volume moves?
A lot of ugliness, really. It's basically stuck right in the middle of the range it's been in for the last couple of years, and it's just from a purely technical chart perspective. Again, we don't see a lot that would have us get aggressive right now, based on the chart itself. It's more or less basically right in the range and alternating between slightly bullish and slightly bearish, with current circumstances really fitting the latter.
Well, Dana, let's also weave in the energy space, oil, nat gas, and the oil and gas stocks. Any thoughts as to direction on those? They almost seem directionless to me, but what are your thoughts on the energy sector?
Yeah, also, like many commodities, kind of stuck in a range right now. Just from a trading perspective, we are shorting oil just purely off of the charts, purely off of technical. So putting on a short in oil, I think there's downside. Right now, we're kind of testing some of that, what's been some of those key moving averages and some fib levels that have been more or less serving as a pivot point, bullish above, bearish below, and we're testing those from below right now. So we're trying a small short position on crude oil right now, just looking for maybe a near term extension down. But overall, from a long term perspective, I don't see the conditions suggesting to be aggressive one way or another right now.
All right, Dana. Look, we've covered a couple markets here. We'll wrap it up here. It still seems like we have a lot of, I guess, trading that you can do within these markets, but not a ton of long-term trends right now. So if that changes, well, I'm sure you'll keep us updated, but you have provided us with some, at least, ideas of how you're trading these markets and where you're positioned. I really appreciate that, Dana. We'll chat again in another couple weeks. Hope you have a great rest of your week.
Sounds good. Thanks, guys.